Now that we have covered the three valuation approaches, there's a concept that runs through all of them. And if we get this wrong, even the best model will give you an unreliable answer. That concept is risk and return. Specifically, how do we translate the risk profile of a business into a discount rate? Now, there are two types of risk. A systematic risk, which is the broad market risk. You can't diversify away. Think recessions, interest rate shifts, geopolitical events. Unsystematic risk is the company or the industry specific. A key man dependency, a single large customer, regulatory exposure. Valuation is mainly concerned with systematic risk, which is measured by beta. Now, beta simply tells you how sensitive a company's return are to the overall market. A beta of 1 means the company moves in line with the market. Above 1 means it is more volatile. Higher risk, higher return demanded. Now, beta for a private SME can't be observed directly. So we derive it from listed SGX peers using a three-stage process, collecting comparables, removing the effect of each peer's debt, and then reapplying the SME-owned capital structure. The full methodology, including peer selection rules, the unlevering formula, and a work Singapore example is all in the guidebook. For now, the key concept is the beta is derived, not assumed, and every input comes from free public data. Now, building the cost of equity, a CPM stack. Start with the risk-free rate, typically the Singapore government bonds yield from MAS, add the equity risk premium, which compensates investors for choosing equities over bond. Then layered on an industry risk premium for sector-specific exposure. A small company premium because smaller business carry more risk than large caps. And finally, the company-specific risk premium for anything unique to this particular business. Now, critical warning about double counting. Now, there is where a lot of valuation go wrong. If you already apply a CSRP, which is the company-specific risk premium, for say customer concentration risk, you cannot then also apply a marketability discount for the same reason. Risk captured in the discount rate and risk applied as post-valuation discount must be kept separate. We'll come back to the detail when we cover DLOC and DLOM. At this point, you have the framework and the risk building block. Now let's zoom out and look at the full process. The 10 steps that take you from a blank page to a sign-off valuation report. Think of this as your GPS route. Miss a waypoint and you need to double back. Now step 1 to 3, the purpose and data. Define the purpose first. Is this for a sale, a dispute, or a bank loan? The purpose determines the standard of value you apply, which flows into every assumption downstream. Then gather at least 3 years of financial statements and normalize them. We'll cover normalization in the next slide, but the key idea is reported financials and economic reality are often not the same thing. Now, step 4 to 6, which is modeling. Now choose your approaches based on purpose and the nature of business. Estimate the cost of capital using the CAPM stack we just covered. Then apply your chosen valuation model, DCF, market comparables, net asset value, and run the numbers. Now step 7 to 8, adjustment and reconciliation. Apply DLOC. Okay, for the lack of control, you are valuing a minority stake. And DLOM if the shares are illiquid, as they almost always are for SME. Then reconcile across methods. You're not picking a single number, you are arriving at a defensible range that reflects the weight of evidence. Then step 9 to 10, documentation and communication. Document every assumption in writing. This is what makes a valuation defensible, not just the number, but the reasoning behind it. Then communicate the findings clearly to your client. A valuation that can't be explained simply isn't useful. Let's go a level deeper on step 3, normalizing the financials. Now, this is one of the most important and most overlooked parts of any SME valuation. The numbers in the accounts are prepared for tax and compliance purposes. Our job is to restate them to reflect what a hypothetical arm's length buyer would actually see. Items like non-recurring items, these are one-off events that inflate or deflate earnings but won't repeat. Now, such as a litigation settlement, a fire insurance payout, a COVID government grant. This needs to be stripped out. You are valuing a going concern, not last year's exceptions. On discretionary and owner expenses. Now, many SME owner runs personal expenses through the business, such as above market salary, a company car, family travel. A buyer wouldn't pay for this. Adjust the owner's compensation to a market rate equivalent and remove personal perks that wouldn't survive a change of ownership. Related party transaction. An owner who rents the business premises from his own holding company at below market rates is effectively subsidizing the business. So you need to adjust the rent to the market rate. Similarly, family members on payroll at inflated salaries need to be restated. This adjustment reveals the true economic earnings power of the business. And on documentation is non-negotiable. Every adjustment must be presented in a table, the items, such as the items, the reasons, the amount, and the direction of adjustment. Now that wraps up on slide 4 to 6 of episode 1. Now if you found this useful, do me a favor. Hit the like button. It helps for more SME owners and CPA find this content. Subscribe so you don't miss the next episode, and most importantly, leave a comment below. Thank you.